We got an economic forecast today, which is always interesting information. Every year we have one. Today we'd like to welcome back James Marple, who will join us for our annual economic review. A veteran of our conference, he's a graduate at the University of Toronto and a senior economist at TD Bank. In his role, he works with a team of economists to provide analysis and forecasts for the American economy. We're not only pleased, but also fortunate to have him. Please welcome James.
I've been called worse things than Marble, so that's okay. I wanted to take a photo of this room because this is by far the biggest audience I ever speak at. So thank you for having me back the last 2 years. It's actually really nice to come back and do the same presentation at the same time of the year because I can go back and look at what I said last year, what I got right, what I got wrong, and it's an opportune time at the start of the year to kind of say, you know, what has happened over the past year and what do we expect to happen over this year. If I think back sort of to a year ago, big thing, we had a newly minted president. There was some questions about his economic agenda, how much tax changes we would get, some talk of infrastructure reform, NAFTA, and immigration changes. So we now have a tax bill that was signed in December. So I'll talk a little bit about that. We have some actual economic implications of changes in policy. We're still waiting on whether we'll get any infrastructure bill, but NAFTA negotiations are ongoing. We'll have the 6th of 7 sessions in Montreal next month. So it still remains to be seen what happens there, but certainly a lot of developments on the policy front. It was an excellent year for the stock market. The S&P 500 was up 20% in 2017. The Dow was up 25%. It's pretty incredible. The bond market kind of round-tripped. If you think, in the aftermath of the election, we saw longer-term yields rise quite a bit. And after Trump was elected, on anticipation of tax policy, yields fell through mid-year. Really on some inflation concerns, which I'll talk a little bit more about. But once the bill has been passed, we now have a 10-year yield north of 2.5%, I believe, north of 2.6%. Short-term yields have moved even faster. The Fed raised rates 3 times last year, and we've seen 2-year yields move up about 80 basis points. And the economy, I think importantly, the economy performed very well in 2017. Better even than expected. It had a bit of a slow start to the year, but made up for it in the final 3 quarters of the year, where growth was close to 3%. So you had, over the course of the year, around 2.5% economic growth. We expect much of the same for the next 2 years. The tax bill and the support to spending, both consumers and business spending from that bill, I think will help maintain economic growth. That's true in the U.S. That's also true in Maine. In fact, just wanted to say that it was also a very good year for the Maine economy. Beat our expectations. We've seen unemployment rates push to new lows throughout the state. So where does that? So the question is sort of where that 2 more years of above-trend economic growth, where does that leave the Fed? That kind of, again, draws on that inflation outlook and will depend on what we see in terms of inflation. One of the things we did not get right, and really no one did, was inflation over the last year. Inflation moved down instead of up, which is surprising given how much improvement we saw in the unemployment rate. We had the unemployment rate move down 70 basis points or 0.7 percentage points, and yet inflation also moved down. That's not what the economic models tell you should happen. So we'll have to see, and that will a lot of what I'm going to say about the interest rate outlook will depend on what happens to inflation over the next year. So I just want to step back just a little bit, talk about the global economy, because 2017 was also a year in which the global economy outperformed expectations, and that is a bit of a sea change. If we look over the last 5 or 6 years, sort of even more since the financial crisis, the global economic outlook has been one of revising down expectations. The governor of the Bank of Canada has called it serial disappointment. That changed in 2017. Forecasts have had to be revised up, and we've seen really across both advanced economies and emerging markets, growth exceed not only expectations but also potential growth rates, given sort of supply side, growth in the labor market. Unemployment rates have fallen pretty much across the globe, and that's important because that's changed now on a global scale the dynamic for monetary policy. We've seen, in the past, the American economy out ahead of the rest of the world. It was the only major central bank that was raising interest rates, slowly at first, but we've now seen other central banks around the world also in lockstep or join the Fed, not hiking at the same rate, but still moving off zero interest rate policy. I mean, it was only a few years ago when we were talking about negative interest rates in Europe, and we think over the next year actually it won't be till 2019 till we expect the ECB to raise rates, but that's a big sea change from a world of negative interest rates to starting to see a move very slowly back to a more normal interest rate environment. Now, this is, I think, an important point because when central banks start raising interest rates, it's typically in a more mature business cycle. And what we've seen in past when business cycles have turned, when recessions have hit, it's of course, it's not when interest rates are zero, it's when interest rates have moved back up to normal. And what's really, I think, an important indicator to watch is the difference between longer-term interest rates and short-term interest rates. And as the Fed has started to raise interest rates, we haven't seen quite the same increase in longer-term yields, and the yield curve has flattened. You notice that prior to the past 3 recessions, we've seen the yield curve invert. So short-term rates were higher than long-term rates, and that's, I think there's good explanation for that, both on the supply side. A negative yield curve is bad for bank profitability, the supply of credit, and on the demand side, it also signals that investors see the Fed making a mistake, or so they're staying in longer-term interest rates or in longer-term bonds for protection rather than sort of going out. I think what we'll see is maybe a bit more flattening in the yield curve, but I don't think it's going to turn negative, and we don't expect to see a recession in the outlook over the next 2 years. I mean, there's nothing elsewhere in the economy that would indicate that that would happen. It's also interesting this time. What makes the situation a little bit different from the past is that central banks have been buying longer-term assets, expanding their balance sheet, and that has put downward pressure on longer-term yields over and above, sort of the normal market environment. We now have central banks unwinding their balance sheet. The Fed is well into that process of gradually reducing the size of its balance sheet, and that is something that if they thought they wanted to influence the yield curve, they could change the pace of that as well. But I think that if you look at sort of try to take out the impacts of quantitative easing, you don't see as flat a yield curve. And we also have had, since the tax bill, we've also seen longer-term rates come up. Even if I were to, this chart it's a few weeks old now. We've seen a turn up in the 10-year in a way that the yield curve is not quite as flat as it was at this chart. So this expectation that we won't see an inverted yield curve hinges on the Fed not making a major policy error. So they will, I think, have to pay attention to it. And we have heard Fed presidents talk about the importance of the yield curve and what it means for the Fed outlook, especially in a world in which they've missed on their inflation target pretty consistently. And in fact, over the last year, inflation, as I mentioned, moved the opposite way. And it's a little bit of a mystery. We know there were some idiosyncratic factors, changes in cell phone plans that really impacted the index. But overall, still, a world in which the unemployment rate is low and inflation is not moving up is kind of strange. So I want to make now in the next few slides an argument that inflation is going to turn higher, and hopefully when I'm talking to, well, if I'm lucky enough to come back in a year from now, I'll be talking about inflation moving a little bit higher. One reason is the U.S. dollar, which was on a tear through 2013 up until 2017, that was a world in which the American economy was outperforming quite extensively most of its major trading partners, including Canada, which was hit by the decline in energy prices through 2014. It has since obviously made a rebound, but the European financial crisis. And now we have a world, as I said, in which those economies are growing faster. Central banks are starting to raise interest rates, and I think that more synchronicity in the global outlook should allow the dollar to move down a little bit. There's a lot of uncertainty around, obviously, in any exchange rate forecast. One thing I would say about the dollar is that if we were to see NAFTA abrogated, the U.S. pull out of the NAFTA agreement, I think you'd see the dollar shoot up pretty dramatically against the Canadian dollar and against the peso. So that is an obvious upside risk to the dollar. That's because pulling out of NAFTA may, and I would make the argument that it would hurt the U.S. It will hurt Canada and Mexico a lot more. So just as I said, the consequence of this above-trend growth is that unemployment rates have pushed really to new lows. So if you're looking at the U.S., the unemployment rate's 4.1%. We have had to readjust what we think is a normal level of unemployment. Prior, a few years ago, even the Federal Reserve thought that around 5.5% was a normal level of unemployment. It's now 4.1%. We think we'll have 2 more years of above-trend growth, which means we should see the unemployment in the U.S. push to the 3s. It wouldn't be crazy to see the unemployment rate hit 3.5 or even below 3.5%. So what that means for Maine, where the unemployment rate has already been structurally over time lower than the national rate, we could see the unemployment rate push into the 2s. So that's a pretty tight labor market, and even more. And you look at Portland. There's virtually nobody unemployed, at least by the official metric. And of course, I have to obviously, when I talk about unemployment, there are other measures of employment and slack in the labor market. You can look at sort of the percentage of the adult population that's employed. But if you do that in Maine, Maine has a higher labor force. Not only does it have a lower unemployment rate, but it's a higher labor force participation rate. May sound jargony, but what that means is more people are actively engaged in the labor market in the state. So it truly is, I think, we are seeing a pretty tight labor market in the state, and especially in urban parts of the state. And the argument that people make that the labor market isn't as tight as the unemployment rate suggests is that wage growth has been soft, has been tepid, and that is true nationally. The wage growth is up about 2.5%. I don't have all the history here, but if you look back a further look back at this chart, we would typically in a more mature business cycle see wage growth in advance of 3%, 3.5 to kind of 4%. This is a nominal, so to see if we have inflation around 2%, real wage growth is relatively weak on a national basis. But if you look across states, you do see that states with tighter labor markets, lower unemployment rates, have faster wage growth. So there is a relationship between the tightness. I mean, it seems silly to think there wouldn't be, but there is a relationship between how tight the labor market is and wage growth, and we have seen over the last year a real acceleration in wage growth in the state, which I think reflects the fact that the labor market is very tight. We don't have wage growth, unfortunately. I don't have data on wage growth by metro area, but we do have sort of job growth. It is the smaller the sample, the jurisdiction, the more volatility and the less accuracy you get so you have to look through a little bit some of the ups and downs at a metro level. But if you look at Portland, it has been keeping pace with the national labor market in terms of the pace of job growth, which is really I think quite incredible given the growth in the labor market and the growth in the population, which is much lower than the growth nationally. But we've seen a lot of growth in healthcare, employment especially, and that's not surprising given an aging population. But of course, the challenge will be maintaining that growth as aging continues on the labor force, as people, especially in healthcare, begin to retire. You need to continue to draw in more workers, and over the last year that has fortunately been happening. But I think that will continue to be the main challenge for Maine and Portland. Okay, so I just want to talk a little bit more about taxes and the tax bill that just passed. I think the one thing about this chart that's a little misleading is the green boxes here should have been bigger than the red boxes, because overall there are the positives, at least in the near term, I think, outweigh the negatives. But a major change in corporate tax policy from a top rate of 35% down to 21%. That puts the United States much more in line with international competitors. If you sort of look at it holistically now, the marginal tax rate on new investment in the United States after this reform is lower than it is in Canada. So we've really moved to a much more competitive international tax regime that should be over time positive for investment, increase capital investment, which is important, I think, to raising the productivity outlook. But in the near term, I mean, it's a big cut in taxes on personal income taxes, moving or reducing the number of brackets and lowering the rates. It obviously is skewed to higher income, where the rate, the top marginal rates have come down. Arguably, from a stimulus point of view, that reduces it, because we don't have people spending as much at the high end. What we call the marginal propensity to consume is lower. But even for the median income, it's a tax cut of about $1,600. So some of that is probably going to show up in higher consumer spending, and that's a lift to economic growth. The full expensing, I think, obviously reduces, again, the tax on investment, especially for sort of longer-lived assets. And then there are, of course, some deductions. So in higher tax states, it actually isn't clear after the reduction for state and local taxes whether you will get much of a tax cut. I mean, that's true California and New York especially. Some of the other reduction in deductions obviously take away from the stimulative impact. But I think the other thing, and maybe perhaps most importantly, is when you have an economy that's operating very close to full potential, and you have a $1.5 trillion increase in the deficit, on the tax side, it's probably going to be met with faster interest rate increases by the Federal Reserve in order to avoid overheating the economy. So some of the sort of near-term impact is reduced just by the nature of having a Fed that's trying to keep the economy on even keel. Okay, so my final slide, just because this is a real estate conference, I thought I'd talk a little bit about home prices. It's been I don't have all the metros on here, unfortunately. Again, there's a lot more volatility in those numbers, but it's been a good year, better than we expected. We've seen price growth in the state about 6%. That's a very good number. I think we will see probably a deceleration in price growth, and one of the things that was in the tax bill that will influence it is the reduction in mortgage interest deduction, which I think will probably change the skew a little bit, or for people who are looking to enter the housing market, maybe they'll leverage. I think we will maybe see a change in the mix of housing towards less expensive homes. Of course, it's $750,000 is the limit on the deduction on mortgage interest, and that's something that it reduces demand relative to supply. So something that you think might see a little bit of a slower growth in home prices as a result. But still, I think we should get modest single-digit growth in home prices, supported by a continued strong economy and very strong labor market, and likely accelerating wages. So that does it for I went over time a little bit, hopefully not too much. if I'd love to take, I think I have time to take a few questions. Yeah. Okay. If there are any. Otherwise, okay. Oh, there's one coming. On the mic.
Good afternoon. My name is Andrew Calise, and I'm a real estate entrepreneur. Do you think the Dow Real Estate Index is going to be up or down this year from now?
Wow, that's a hard question.
Thank you.
You know, I would have a forecast. This is what the forecast. I don't know if I have it. I would see it going kind of this way, and then my confidence bands are like that. You know, like, so I don't know. Basically. That's. I mean, you know, I'd have. If I was a more savvy investor, I wouldn't be here. I'd be on my yacht. I'd put all my money in Bitcoin 2 years ago. Okay, well, I'm going to leave it. Okay, got a question here.
Where do you see interest rates going this year? It wasn't super clear.
Okay, great. Yeah, yeah. So the chart, I guess I didn't say it, but so the Fed for the Federal Reserve, we expect to see a hike in March at the next. They meet this month. We don't think they'll raise rates at the end of this month, but they're meeting in March. That's when they have a press conference, and they've kind of put their rate. They've tended to raise rates every quarter. At those meetings where they have a little bit more information, when the governor or the Fed chair comes out and can talk about it. So we think we'll get a rate hike in March. I would think that perhaps another one in June, and then one more in the second half of the year. So we expect to see 3 this year. Again, that's contingent on inflation moving steadily higher, and I think there's a good case that it will. And then we think we'll get 2 more in 2019. So we're talking about over the next 2 years, 1.25 percentage points in interest rates. And I think we should see longer-term rates move maybe a little bit less than that, but still about at least 100 basis point increase. So we have we expect to see the U.S. 10-year rate, and of course, mortgage rates are priced off that, move to about 3.5% by the end of 2019. All right, thank you very much.